Hey guys, welcome back to the Joyful Investors channel. So in our previous video, we talked about the FIRE movement, how to FIRE, and also shared what I personally do to FIRE. So when we talk about FIRE, one frequently used rule of thumb for computing retirement spending is the 4% withdrawal rule. The 4% withdrawal rule can be used to calculate how big an investment portfolio you need to fund for your retirement spending if you withdraw 4% a year from the investment portfolio during your retirement years. So let's find out how this rule works. So here's a short illustration. Let's say you need to spend 3K a month during your retirement years. The annual expenses will then be 3K times 12 to be 36K. So applying the 4% withdrawal rule, you just take 36K divided by 4% and you'll get 900K. This means that you will need a 900K investment portfolio upon retirement to fund for your living expenses. Subsequently, for each year, the amount that you withdraw will then be inflation adjusted. Take for example, if the inflation is 3%, then the amount that you withdraw for the second year will be 36K times 1.03, which gives you about 37K. You may be thinking, wouldn't the investment portfolio run out of money? There have been studies and simulations conducted using historical stocks and bond performances, and they have shown that there is generally a higher chance that one would not run out of money using a 4% or lower withdrawal rate. Based on the Trinity study, which researched a combination of investment portfolios across varying periods and withdrawal rates, it has been shown that for a 30-year retirement period, the chances of having sufficient funds to withdraw during the 30-year period can be as high as 95% for a 100% stocks portfolio. The mechanics behind this is that the investment portfolio will continue to grow while you are withdrawing from the portfolio to finance your expenses during the retirement years. Just like an apple tree, we can pluck some apples from the tree to eat. But as long as the tree is still growing healthily, it will continue to bear more apples in time to come. But at the same time, we can't pluck too many apples at one go, or else the new apples can't grow in time for our future consumption. Before we go on, let me share a quick message from the sponsor of this video, uSMART. uSMART is currently running a promotion this month where you can receive monthly cash and stock vouchers worth up to $400 when you open a uSMART account, deposit and trade. From now till 31st December 2002, you also get to enjoy unlimited zero commission fee for US, Hong Kong and Singapore stocks, and there is no minimum charge for Singapore stocks. Terms and conditions apply. uSMART is also one of the few brokerages which offers fractional shares trading and featured strategies curated by uSMART market strategies and analysts for investors. If you are keen, you can look out for my referral link in the description box below. And let's proceed on with the video. Nonetheless, there are some limitations for this 4% withdrawal rule that are less spoken about. Firstly, withdrawing from the investment portfolio during a market downturn may not be the best idea for your investment returns. This is because that will leave the portfolio with a smaller amount to compound when the market subsequently recovers. And we will be converting some of the unrealized losses to realized losses during the market downturn when we withdraw from the portfolio. Secondly, the conventional wisdom to hold a diversified portfolio that is made up of stocks and bonds does not hold in today's market condition. For many years, it has been commonly advocated that investors should build a diversified portfolio made up of both stocks and bonds to reduce fluctuations. Likewise, the Trinity study was also conducted on different combinations of stocks and bonds. The rationale behind this conventional wisdom is that equities and bonds are negatively correlated, which means that when equities do not do well, bonds will do better and can thus cushion the downside fluctuations from equities. However, based on the past 90 years of historical data compiled by Schroders, there have been periods where equities and bonds showcase both positive and negative correlation. In our current high interest rate environment, both equity and bond prices are depressed. Thirdly, this safe withdrawal rate concept is built upon the assumption of a fixed spending pattern where we assume we will spend the same amount every month, which may not happen eventually. And lastly, the data used in the Trinity study may be outdated, as the first study was done using data up to 1995 and updated in 2011. At the end of the day, we must learn to be more flexible as circumstances may change. We can use the 4% withdrawal rate as some kind of benchmark to compute roughly how big a retirement portfolio we need. But that would just give us a ballpark figure, which we need to adapt to any changes and circumstances along the way. Or we could also use a withdrawal rate that is lower than the 4% to provide some leeway. So taking into account the limitations of the 4% withdrawal method that I mentioned previously, personally, this is how I would like to allocate my wealth by retirement. One of the luxuries of living in Singapore is that when it comes to investments, we have Singapore REITs, which provide decent dividend yields, and the dividend income is not taxable in Singapore. Therefore, by retirement, I would like to construct a Singapore REITs portfolio whereby the dividends distributed would be sufficient to cover my living expenses. So we have to do some calculations as to how big the REITs portfolio has to be in order to support our living expenses during retirement. If you want to learn more, you can check out this video that I have linked up in the top right hand corner. Then, it is also important that I keep some cash for emergency uses, which could be, for example, medical related events, or say if there is a sudden market downturn, just like during COVID times, where the REITs lower their dividend payout, which I might then need to tap on this pool of cash to cover my spending. And for the remaining portion of my money that I don't need for the next 5 to 10 years of consumption, I will then allocate them into the US stocks portfolio. This is the pool of funds which I do not want to withdraw in the near term, so that I can allow the capital to continue to compound. Or if in the event, if there is any short-term pullback in the US markets, I do not want to realize the paper losses because it would then slow down the compounding effect as I have shared earlier on. So the way that I'm adopting is that I'm just using the 4% withdrawal rule to let me have an understanding of roughly how much money I will need to have by retirement. Then when it comes to the actual allocation and execution, I would like to tap on the consistent and reliable dividends distribution of Singapore REITs to finance my living expenses during retirement. Thank you for watching this video, and if you enjoyed the video, do give me a like and subscribe to our channel.